Well, good afternoon, everybody. It's morning for me. I just flew in this morning, so I'm going to try to keep my energy level up. One of the things that we heard about in the previous presentation, and I would certainly echo it, is that we've gone through a period of disruption to many of the industries that we're familiar with. So the example was given about the music industry. I could give you a similar example about the steel industry. But what's really consistent about all of these forms of disruption is that they typically are characterized by young disruptors using technology to fundamentally change the business models through which we compete. But the interesting thing is that the financial services sector has, over time, more or less remained immune from most of the changes. And there are good reasons for that. So, number one, financial services has been largely protected by the regulatory regime. The second is that financial institutions, especially the incumbents, have tremendous scale. And especially when you think about balance sheet activities, that scale provides barriers to entry for some of the new and exciting startups. And then I think the third and potentially most important advantage that incumbents have had is that they have consumer trust. And consumer trust is very difficult to replicate or manufacture. And so over time, you've seen a number of different spikes in innovation. So we would all remember the upstart digital banks of the 90s or digital cash, things of that nature. But as much as they came and attracted a lot of journalistic attention, they went away almost as soon as they came. But I think we're in a different era now. And so the reason I think we're in a different era is a couple of key statistics. So number one, the amount of investment in the fintech space has gone from $7 billion 3 years ago to $14 billion last year to $30 billion US as planned for this coming fiscal, which is a massive change in behavior. It's also the case that we're having different conversations. So on my World Economic Forum steering committee, one of my executive constituents made, I think, a very astute argument, which is that this is potentially the most interesting and valuable conversation that we've had in years, because following the financial crisis of 2008, we spent the subsequent years arguing over who was at fault and who should be in charge now. Whereas the conversation is starting to turn to what should the future of our industry be, how do we improve our profitability, and fundamentally, how do we better serve our customers? And so what I think is interesting is that the traditional financial institutions that we're all familiar with and in some ways represent are starting to take this threat and cultural change quite seriously. And so you see the quote from Jamie Dimon at JP Morgan, Silicon Valley is coming with a lot of brains and money working on various alternatives to traditional banking. And it was folks like Jamie and others on our steering committee who asked us to go and take a deep dive into the world of disruption in financial services and help the executive body have a productive conversation on this topic. And so what we did was we set out to create what is still to this date the largest study of disruption in the financial services sector. But there are a few things that we did which I find to be hallmarks of our success so far. The first is that we didn't simply set out to ask bankers to opine on banking, because that would have been a linear conversation, and as I like to say, it would have been probably very boring. What we ended up doing was creating a multi-constituent organization representing over 100 of the leading financial institutions in the world, represented specifically by their CEOs or functional equivalents. But we didn't stop there. We also went out and invited over 200 fintech CEOs and their equivalents to join us in our forums, representing some of the most exciting startups in the world today across every aspect of financial services. But of course, that's not a complete set. So we went out and we gathered from our World Economic Forum constituency a panel of some of the world's leading regulators representing most major geographies around the world, and finally rounded out our set with some of the most important thinkers in the academic space, like our colleagues at the MIT Media Lab. And what we did was construct global forums to think about how the world might unfold in financial services, not with the objective of creating a singular version of the future, but more so to think about what are plausible versions of the future, and then what conditions would have to take place in order for disruption to occur. And so, as you can see in the diagram that you have above my shoulder, we looked at the world across payments, insurance, deposits and lending, capital raising, investment management, and market provisioning, and decomposed, in our view, what the most important implications would be to each one of those sectors. Today, though, what I thought I would talk to you about are some of the macro findings, the most important things that cut across each one of the sectors, and I would say hold true across the entirety of the financial services disruption conversation. The first finding that we had was that innovation in financial services is deliberate and predictable. And so this would have come from a discussion that we would have had, quite a deep discussion that we would have had with our executive base, who would have said to us, you know, the issue with this topic is that it feels like innovation in financial services is coming from all sides. It's random acts of violence. We don't know as a traditional institution where we should be placing capital bets, where we should be on the defensive, where we should be on the offensive, and how we should think about how to plan our organizations and our innovation intent. And so one of the things that we found that was quite interesting, especially in dealing with the fintech folks, is that they have a very clear perspective on our industry. Whereas in previous rounds of innovation, you would have seen organizations coming to market trying to replicate the entire bank. These folks are being much more selective. What they're doing is they're looking at our industries and they're saying, where do the greatest sources of friction exist for customers? And then they're doing a similar analysis and saying, where in financial services do you have the greatest undefended profit pools? And instead of replicating the entire bank, they're coming to market with very specific innovations targeted at very specific parts of the value chain. So in the previous presentation, when we saw value at risk, I absolutely agree that value at risk in the current state is in payments. But there's a good reason for that. Relative to this example, what we've done is we've done a global analysis of diversified financials. And what we've found is that with some degree of consistency, if you add up all the profit pools associated with payments, it represents about 1/3 of total financial institution contribution, which is amazing because we don't really think of our businesses like that. We know mortgages is typically 10% of total contribution, but we've never, in most organizations, taken the time to add up all the profit pools associated with payments, and most folks are surprised at the magnitude. But the fintech folks get that. And so they look at payments and say, wow, this is a business that just shouldn't operate like that. It takes too long to get money transferred. It's too expensive. There's too much friction. And so that's why we're seeing the first signal shots of innovation being fired in the payment space. To me, I think TransferWise is a great example of how innovators are taking a look at our payment space and trying to innovate or disrupt it. So if you take TransferWise, focus specifically on international remittances, what they've done is taken a process that typically takes 3 days and is very expensive down to near real time and near free. And what's happening is that they're now responsible for clearing over $1 billion of payments on a cross-border remittance basis every single month. Or if you take a look at Algomi, which is another company that I think is tremendously interesting, what they're doing is providing a matchmaking service in the OTC fixed income market. You all know probably that in the OTC fixed income market, one of the core challenges is finding counterparties without exposing your position. Well, Algomi is a platform that steps in and revolutionizes this part of the market, which has been designed for opacity. And I think that these are two great examples of finding friction points corresponding to relatively undefended profit pools, and where we can take a look as our traditional organizations at our own business, diagnose where those levels of threat are likely to come from, and start focusing our efforts there. The second finding is that innovations are having the greatest impact where they employ business models that are platform-based, data-intensive, and capital-light. So I think most of us would be familiar with the examples of Uber and Airbnb. And what's great about those companies is that they would be considered platform companies. They're doing a wonderful job of connecting buyers and sellers to solve the mutual needs of those two bodies without actually taking risk in the center. And this type of patterning has not gone unnoticed in the financial services sector. In fact, I would point you to the marketplace lending space with examples like Lending Club, Funding Circle, or On Deck, where you have these organizations who are sitting in the middle of folks who need capital and folks who have excess capital to deploy, and they're creating a marketplace outside the treasury matching and leverage structure that we all participate in as banks. What's wonderful about the model is that they've been able to grow their revenues exponentially without putting a single dollar of capital at risk. One thing I would say about the marketplace lending business, though, before we go on, is that you might wonder how much of this is actually going to take hold. How real will this be? Well, I can tell you, specifically in the US market and the UK market, marketplace lending has become quasi-mainstream at this point. In fact, the recent Morgan Stanley report suggested that marketplace lending will now eat up about 6.5% of total originations in those markets by the year 2020. So it is an absolutely credible and real threat to the business. But of course, not all of the disruptions are actually negative disruptions. And so the next one we'd talk about is the fact that if you were to think about how organizations in this space are competing, most of them are employing what we would call parallel strategies. And those parallel strategies involve both competing head-on with these disruptors, as well as using their infrastructure to provide these folks access to the traditional financial services system. So there are great examples. I think one of my favorites is in the wealth management space, the one that's on the board. So we have Vanguard, who I think most of you would know, who's one of the largest ETF providers in the world. And you have Wealthfront. Now, Wealthfront is an interesting US West Coast-based company that started up as one of these robo-advisor models. They're specifically targeted at millennials. And what's interesting about their platform is that it's outcome-based, highly experiential, segment-driven, so built around the customer back. They use passive investment in vehicles instead of active investment vehicles, and they're able to drop the cost of wealth management from a global typical rate of about 2.5% for a mutual fund to something closer to 20 to 30 basis points for managed services, which is a tremendous cost benefit for the average retail investor. In response, the average retail investor has allowed them to scale their assets under management at a rate that exceeds any organization in the history of wealth management. So they were able to, for example, get to $2 billion in assets under administration in 3 years. Charles Schwab, which would have been the previous most quick grower in that space, would have taken almost 8 years to achieve the same target. And that is the speed at which these companies can scale. So if you're looking at this from the perspective of a company like Vanguard, you might say this is a tremendous competitive threat given that most of these platforms are based on exchange-traded funds and we're one of the world's largest manufacturers. Well, as it turns out, Vanguard was an early partner of Wealthfront and ended up being the provider of about 90% of the ETFs that actually flowed through the Wealthfront platform, meaning that as Wealthfront scaled, so did the Vanguard ETF business. More so, even recently, you would have seen Vanguard take a different move and launch something called the Personal Advisory Service. And Personal Advisor Service is a parallel model built after Wealthfront with many of the exact same characteristics, keeping in mind they're the same products that are on the shelf in the background, and now they have head-to-head models competing with each other. They have their traditional business, and they're providing 90% of the ETFs on the Wealthfront platform. That's a great example of coopetition as opposed to competition. I think the same thing could be said in the lending space. One of my favorite examples is Union Bank out on the west coast of the US, where as opposed to fighting the marketplace lenders, what they've done is said, you know, we have a risk box that we just can't operate outside of. And so naturally what's going to happen is that there are going to be customers who do not fit that risk box, and they're going to have to be declined for loans. But as opposed to just declining them cold, why don't we partner with a marketplace lender to send them active referrals and take part of that business in exchange? And that's been tremendously successful for them. The next topic that we've found is that collaboration between regulators, incumbents, and new entrants is absolutely needed to understand how innovations are going to impact the sector both positively or negatively. And you might wonder why it is that we have a Twitter example here on when we're giving this talk. And the reason for that is that in 2013, there was a false tweet about a bombing at the White House. Less than 2 minutes later, $136 billion in value was wiped from the S&P 500. Why is that? It's because many of the new algorithmic trading models that are being deployed on Wall Street use social media as an input into their trading triggers. And so when you think about that from a regulatory perspective, you think this behavior is just so far outside of what was being contemplated when these rules were being created that we don't really know how to effectively regulate this type of activity. So I think there are some interesting global developments. What we would say is that the money transfer regulators and the consumer regulators are absolutely on the front line of trying to understand how these changes are going to impact the sector. One of the best examples, in fact, I would refer to them as the gold standard, would be FCA in the UK. FCA has done a tremendous job of founding what they call Innovate Finance. It's a regulatory body under FCA which is specifically charged with making relationships into the fintech ecosystem, doing regulatory sandbox development to actually work with these folks to understand how new business models will impact consumers, the structure of the sector, systemic stability, etc. And then looking at how they might retroactively have applied regulation to various scenarios that those business models might create. And in doing so, what it does is it allows the FCA to be on the forefront of thinking about how you can take innovation, apply appropriate levels of regulation to stimulate competition and consumer benefit in the sector, but also maintain systemic stability. But see, the challenge here from a regulatory perspective is that the world is becoming incredibly more complex than it ever was before. And so when you have jurisdictions that operate on a principles versus rules-based regulatory environment, as many Western economies do, what it does is it puts a much greater burden on the regulatory examiners to understand these new models and figure out how the implications will affect various aspects of the economy. And quite frankly, on a global basis, we're just not there. The second topic that comes up quite frequently is the whole notion of institution versus activity-based regulation. So most regulation, prudential or otherwise, takes a look at our sector and breaks it down by insurance companies versus banks versus other types of deposit takers versus money transfer organizations, et cetera. And you all know this as much as I do. But the challenge is that most of the threats are not coming from the traditional conceptions of these institutions that we're aware of. In fact, there are great examples, as I talked about in my first slide, about how you have point solutions which are playing a material role in the effectiveness of the sector. So you might ask yourself the question, if I had a software provider who was responsible for a specific part of our anti-money laundering activity as a bank or insurance company, and that software provider was externalizing a process on our behalf, how are they captured in the regulatory fabric? And the answer to the question is they're not. And it's not just here, they're not anywhere in the globe captured within the regulatory fabric. And so this is why the number one topic that we discuss with our regulatory governing council is what will need to take place in order to have a more comprehensive activity-based regulatory framework on a global basis as opposed to simply relying on an institution-based regulatory framework. Now, also it's the case that not all innovations are customer-facing. A quiet band of innovators are modernizing incumbents' practices, delivering new capabilities and unexpected efficiencies. I think this is probably the most profound of the examples, because what we're seeing more often than not are incumbents taking a look at these organizations and saying, how can we effectively use the Valley or Tel Aviv or wherever they are in the world to outsource our R&D? Meaning, we have a lot of capital, we have a lot of scale, we have smart people, and as we talked about in the last presentation before me, all you have to do is get the business model right. You don't necessarily need to be first. And so many organizations are taking a look at organizations like Kensho or FundApps and saying, how can we internalize these organizations, these platforms, these providers to supercharge our existing business? So the two examples I've given you, I think FundApps is a really interesting one. What they do is they monitor and organize regulatory data from over 100 regulatory regimes. They automatically keep track of investment restrictions and automate the creation of disclosures. And why that's interesting is because if you were a wealth management organization and you were looking to scale globally, every market that you went into, you would have had to have relationships on the ground, you would have had to have lawyers, you would have had to have compliance staff, you would have had to have a whole gamut of offline functions in order to allow you to participate in that market. And it's for those reasons that you would have said scale is tremendously important in most aspects of financial services. But I think examples like this challenge the notion that scale is important, because what these folks are doing are allowing smaller organizations who don't have that global scale to still enter markets at random, at will, participate successfully, and use platforms like this to outsource regulatory compliance. And so we do think that one of the core orthodoxies, if you will, in financial services, that scale is an absolute competitive advantage, will start to dissipate over time as more of these examples start coming up. And then finally, we talked a little bit about value at risk in the last talk. I think that it's absolutely the case that the most imminent effects of disruption are taking place in the banking sector. As I said, the first signal shots are in payments and lending, and that has to do with the friction points vis-a-vis the profit pools. But I think that the greater long-term disruption is absolutely coming to the insurance sector, and I'm not sure that I would say P&C and life are materially different, and here's the reason why. When you think about the core capabilities of an insurance company, it comes down to, at its most simple level, the ability to pool risk and the ability to price risk. Those two functions are inherently the most algorithmically susceptible of anything else in the financial services world. There's another reason for it. Once we get to the level of having data, granularity of data, transparency of data, and real-time data flows, the nature of risks themselves are becoming commoditized. So there are great examples. The self-driving car in the P&C world is interesting because the risk of having an accident drops to negligible values. But I don't think that that's all. In the life and health space, there are really great examples, whether it be through wearables or other types of technology, where individuals are starting to get such a granular view of their own individual risk profile that they're able to determine, as laymen, as individuals, they're able to determine whether their risk profile and associated pricing is better or worse than the group plans that they're participating in. And in many parts of the world, what you're starting to see is individuals who believe that their risks are more advantageously priced. They're starting to extract themselves or drop out of group life and health plans. This is especially prevalent in ASEAN, Southeast Asia, and most applicable to longevity policies. And so what ends up happening is not only does the risk premium available to insurance companies decrease, price and margin compression come down, but also it's the case that you result in adverse selection for whoever's left in these larger group plans. And so for those reasons, I think that the life and P&C sector are susceptible to the same macro trend. I don't think it's all about distribution by any means. And then the last one I would suggest on the insurance sector is the whole notion of externalities, which are starting to affect the way that consumers behave. So I offer the example of the sharing economy. If you are an individual who drives for Uber and rents their basement apartment on Airbnb in order to have sources of income, it's no longer the case that we can simply adjudicate your risk based on the underlying asset. We can't just look at your car and say your car carries this level of value and therefore the risk is X or Y. We need an ability to extract the risk from the asset and apply it to the individual across a portfolio of assets. And in doing so, it actually demands a risk evaluation model which is not inherently embedded in any of the insurance companies that we're aware of. It's actually an entirely different way of looking at risk, which is now spreading across the lending spectrum, the payment spectrum, and all other forms of financial services. So for those reasons, plus others, we're incredibly concerned about the insurance sector relative to the banking sector and continue to focus a tremendous amount of our attention on remediating risk in that space. So I know that we're running a little bit behind on the agenda today, so I thought I would just pause there. If anybody has questions, I'd be happy to take a few, assuming that time permits, and if not, I can absolutely be caught after the event out in the lobby. But thank you for your time and attention. I greatly appreciate it.
Já, við gjörum svo vel, þá opið fyrir spurningar, við sem að taka eina spurningu og svo síðan þá að menn geti náð tali af Rob og kollega hans. I understand that you brought with you a colleague and we are very happy that you are willing to participate in some private discussions afterwards in the break, or during the refreshments.
That's true. I might just say that my colleague, I brought my colleague Christine Robson here with me. Christine leads the digital identity project at the World Economic Forum, focused on the role that financial services organizations should play in developing digital identity, and both of us would be available afterwards.
Yeah, okay, thank you very much. So any questions from the audience? What? Please,
I have a question about the economies of scale for a small market like the time lag between what we see in the US today versus when we'll see something similar in Iceland. I'm looking at the fintech companies that have relatively high startup costs but low marginal cost, and on the marketing side we need economies of scale to mitigate the risk. So what do you think that when will we see the chairmen of the Icelandic Bank sending out a note about the Silicon Valley?
So maybe just to recap, the question, I believe, if I understood correctly, was at which time will we start to see the same level of fintech participation in the Icelandic banking sector as we're seeing in other parts of the world? Is that fair?
Yeah.
So I'll confess to you that I'm not dramatically familiar with the Icelandic banking sector, although I have a decent amount of understanding, at least enough to be dangerous. I think there are a couple of things that seem to drive greater participation of the fintech sector. I think one of the characteristics that we see globally is the regulatory climate and the willingness of the regulator to engage with the fintech sector. I think that I would suggest that a collaborating condition would be the tax structure of the economy and whether or not technology companies such as that we see in the fintech sector would believe that it's tax advantageous to actually begin startups in the economy. But if you think more broadly and you think about why fintech organizations would be interested in the Icelandic sector, you have to think about the way that most of these organizations are being scaled and what goes through the mind of a CEO of a fintech as they're thinking about markets to play in. Well, the number one thing that they think about is, which organizations can I partner with that are going to get me closer to their customers as soon as possible? So it's incredibly easy to work with one of the world's largest banks to become one of 43 pilots that they have testing the same technology, and it'll take 3 years before you're allowed to actually be put in front of customers. What we've seen in smaller markets is that the willingness for banks and more contained economies to be aggressive in the way that they use fintech organizations to power their business, the way that they're willing to experiment and put these folks in front of their clients sooner rather than later, actually makes smaller economies very, very attractive as a test bed for these fintech organizations. It would be one of the contributing factors as to why the Israeli market is now a hotbed for fintech innovation, because the Israeli banks were very, very early on the draw in terms of supporting that type of activity. Now, of course, I couldn't discuss in detail the regulatory climate or the tax climate. Certainly that's up for you for interpretation, but certainly the willingness of the banks, I think, is an open question.